Welcome, everyone. For years, we've heard the alarm bells ringing about the USA's national debt. I mean, it's a truly staggering figure, right? Makes it the most indebted institution in history, nominally speaking. We see the headlines constantly. We worry about future generations. The specter of inflation always seems to be looming. And then there's China. From the outside, it projects this image of, well, fiscal discipline, quietly buying up U.S. debt, its own finances seemingly under tight control. The narrative seems crystal clear. America, the spendthrift borrower. China, the responsible saver. But what if that apparent truth is just a powerful illusion? What if China's debt problem isn't just as bad as America's, but could actually be 3 times bigger? How can something that massive, that critical to the economy, remain so completely hidden? And what does this revelation truly mean for the global economy, and maybe most importantly, for you? Before we start peeling back the layers on these hidden figures and exploring this global economic mystery, just a quick reminder, make sure you're subscribed to Geopolitics Gazette. You'll get more essential insights there on the world's really complex issues. Okay, so let's look at this initial illusion first. The widely reported government debt figures, they make China look remarkably healthy, don't they?
They do, on the surface.
Its central government debt is sitting around, what, 84% of its GDP?
Yeah.
Which looks incredibly modest when you stack it against the USA's 123%, or, goodness, Japan's 250%. Plus, we constantly hear about China buying up other nations' debt, especially U.S. debt. It creates this really compelling story. China, the disciplined lender, versus the USA, the spendthrift borrower.
You're right to highlight those numbers, but they are deeply misleading. They just don't capture the full picture, especially when you factor in China's incredibly unique economic structure. And, the challenge of getting reliable economic figures from China, particularly down at the provincial level, it's immense. Even international bodies like the IMF, the World Bank, they largely rely on government reporting. And there's ample reason to believe those numbers might be massaged, let's just say. Optimized.
Right.
So it really demands a healthy dose of skepticism from us.
Okay, so if the official numbers are kind of a distraction, then where is China's real debt hiding? You mentioned the unique structure.
Well, the key difference from the U.S. lies in who is actually doing the borrowing.
Right. In the U.S., it's mostly federal debt, right?
Mm-hmm.
State and local adds maybe another 12% GDP, so total government debt is around 132%.
Exactly. But in China, debt is deliberately obscured. It's spread across multiple government levels, government-controlled corporations, and these special entities designed specifically to keep it off the central government's balance sheet.
Okay, so break that down. Where are these hidden layers?
Well, there are 2 main layers we need to look at. First, you've got the provincial and local governments. Now, unlike in the U.S., these entities in China have both the mandate and, frankly, the incentive to take on massive debt for large infrastructure projects. Conservatively, the debt owed just by these local governments was estimated at least $12.6 trillion in 2023. That's roughly 76% of China's entire economic output.
76%. Just from local government.
Just from them. So when you combine that with the central government debt we mentioned earlier, China's total government debt to GDP ratio suddenly jumps to about 160%.
Wow. Okay, so that's already 30% higher than the USA's total government debt ratio.
Precisely. And we haven't even gotten to the biggest part yet.
There's more.
Oh, yes. The second, and arguably more significant layer, comes from what are called state-owned enterprises, or SOEs. Think of these as government arms sort of disguised as corporations. They borrow enormous amounts, ostensibly for profit-generating projects, but in reality, they're executing Communist Party goals. Crucially, this keeps trillions in debt off the central government's official books.
Can you give an example?
Sure. China's State Construction and Engineering Corporation, it's the world's largest construction company. They handle massive projects like the Beijing airport or even building an entirely new capital city over in Egypt.
Right.
These are clearly national interest projects, but the debt doesn't sit with the central government. The SOEs just borrow the money directly, and the scale is just mind-boggling. Some research suggests there are nearly 400,000 fully state-owned firms and maybe over 1 million with some state ownership.
1 million? Good grief.
And these SOEs are highly leveraged. They've accumulated an estimated $30 trillion in debt. 30 trillion.
Dollars.
30 trillion.
Yeah.
On top of the 160%.
Exactly. And if these companies start to falter, which some are, the government would almost certainly have to bail them out. That effectively brings that debt right back onto the national balance sheet, one way or another.
So, okay, let me try and add this up then. Central government debt plus the provincial and local debt plus this colossal $30 trillion from the SOEs. China's collective government debt isn't 84% of GDP. It's It's over 300%.
That's the conservative estimate. Yes, over 300% of GDP. It fundamentally changes the entire comparison with the U.S.
That figure just completely flips the narrative.
It does. But there's another wrinkle. This 300% figure itself relies on China's official GDP numbers being accurate.
Ah, and you mentioned skepticism about those earlier. Exactly. Many economists are deeply skeptical. There's independent research suggesting that due to what some call routine compounded inaccuracies in reporting over years, the Chinese economy could actually be anywhere from 20% to maybe even 60% smaller than the official figure state.
60% smaller. That's huge.
It's a massive potential discrepancy. And if those lower GDP figures are closer to reality, then China's debt to GDP ratio isn't just 300%. Conservatively, it could be as high as 450%.
450%. That's 3 times higher than the USA's total government debt ratio.
Correct. 3 times higher.
Okay, now here's something that feels really counterintuitive then. We know a country's credit rating affects its borrowing costs, right? Lower risk usually means lower interest rates.
Generally, yes.
The USA is rated AA plus A, China is A plus A. So China is seen as slightly riskier.
Yeah.
You'd expect China to have to pay higher interest rates to borrow money, wouldn't you?
Logically, yes, you would.
Yet a 10-year U.S. Treasury bond yields, around 4.5% right now? But an equivalent Chinese 10-year government bond yields just 1.7%. That's almost 3 times lower. Why on earth would anyone lend to the comparatively riskier Chinese government for such a significantly lower return? Doesn't seem to make market sense.
It absolutely highlights that China does not operate as a, let's call it, normal free market economy, especially in its financial plumbing. One major reason for those incredibly low rates is strict capital controls. It's actually quite difficult for most Chinese individuals and even institutions, including large state-owned banks, to just go out and buy foreign assets like U.S. Treasury bonds.
So they can't easily shop around for better returns elsewhere.
Pretty much. So when the Chinese government needs to borrow money, it doesn't really face global competition for lenders in the same way the U.S. does. It essentially has a captive domestic market. The money stays inside the system.
Okay, that explains part of it. But still, within China, wouldn't investors look for better options than those low-yield bonds?
Well, that's the other key point. There are surprisingly few viable investment alternatives within China itself. In a typical economy, if bond yields are low, investors usually pile into stocks or maybe real estate looking for better returns.
Right.
That dynamic doesn't really work the same way in China. Despite decades of huge economic growth, China's stock market performance has been, lackluster. It's risen less than 100% since the year 2000. Compare that to the U.S. market's over 300% return in the same period.
Less than 100% in over 2 decades. That's surprisingly low.
It is. And in just the last decade, while the U.S. market is up over 150%, China's main stock indices have actually gone backwards, declined.
What's holding it back?
A big part of it is that many of the listed companies are, again, state-owned or heavily influenced by the government. They often prioritize party goals like employment or strategic initiatives over maximizing shareholder profits. Plus, you have unpredictable government interventions. Think about Jack Ma's Ant Financial Group getting its IPO blocked at the last minute, or the sudden crackdown on the private tutoring sector in 2023. Things like that really spook investors.
I see. So the stock market feels too risky for the potential returns.
Exactly. And that has knock-on effects. It means independent, innovative businesses outside of government-favored sectors struggle to get funding through the stock market.
That's a truly unconventional market setup. And speaking of unconventional things, before we get into how this connects to the famous real estate bubble and China's unique way of actually funding all this debt, if you're finding this exploration of global economics useful, remember you can get more essential insights by subscribing to Geopolitics Gazette. It's definitely worth checking out. Okay, so let's shift focus a bit to another really striking difference. How Chinese households behave. Consumer spending, household consumption, makes up a remarkably low 39% of China's GDP.
Yeah, it's incredibly low.
Compared to the USA's 68%, or even the global average around 56%. It seems paradoxical, right? You'd normally expect people in relatively poorer countries, on average, to spend a larger share of their income on essentials.
You would. It's one of the big puzzles about the Chinese economy.
So if Chinese households aren't spending that much, relatively speaking, and we just established the stock market isn't a great option for their savings, where is all this money going?
Well, the answer, for decades, has overwhelmingly been real estate. It became essentially the only significant asset class for Chinese savers to put their money into, to the point where Chinese real estate is now the single largest asset class in the world, just within China
The
itself.
single largest asset class globally. Wow.
Yes. And this laser focus on property has led to, frankly, insane unaffordability.
Hmm.
Housing costs in Beijing are estimated at something like 35 times the average income.
35 times.
Compare that to London at maybe 19 times, Sydney 13 times, LA maybe 7.5 times. Chinese cities are as expensive as major global hubs, but the average incomes just aren't anywhere close.
So people are taking on huge debt just to buy these incredibly expensive apartments.
Exactly. This frenzy has also fueled a massive buildup of household debt, mostly mortgages for these properties that seem increasingly out of reach for the average person. And here's another strange outcome: deflation. While property prices went stratospheric, prices for general consumer goods in China have been more or less flat for the last 25 years.
Flat prices for 25 years. That sounds odd. Isn't deflation bad?
It can be very problematic, yes.
Yeah.
It's often a symptom of supply massively outstripping demand. If people expect prices to stay flat or fall, they have little incentive to spend money now. And businesses have less incentive to invest if they can't raise prices. It can really stifle broad economic growth.
Okay, so we have frugal consumers, a weak stock market, low bond yields. Where does the money actually come from to fund all the government and SOE debt we talked about? Is it just the household savings going into property?
Not directly funding the government debt, no. The actual funding mechanism is, well, it's largely internal money creation. Between 2000 and 2019, China's M2 money supply, that's a broad measure of money in the economy, it multiplied 16 times.
16 times. How'd that compare to the U.S.?
In the same period, the U.S. money supply roughly tripled. So China's money supply grew more than 4 times faster.
How did they do that without triggering hyperinflation?
Essentially, when a Chinese government entity or an SOE needs funding for a project, the state-owned banks are often directed to, well, basically create the digital money and lend it to them.
They just create the cash digitally.
That's a simplified way of putting it, but yes.
Yeah.
The banking system, directed by the state, facilitates the lending. And the reason it hasn't caused rampant consumer price inflation, the kind measured by the CPI, is largely because, as we discussed, Chinese consumers are incredibly frugal. Demand for everyday goods hasn't soared despite all this money sloshing around. It has gone somewhere, though, into asset prices, particularly real estate. But because consumer inflation stayed low, the state banks could keep lending at those very low interest rates we talked about earlier, preserving the real return for those internal lenders, which are often other state entities.
Right. So the inflation didn't show up in groceries. It showed up in apartment prices.
Percent.
Okay. So let's recap. We're looking at potential government debt figures ranging from 300% to maybe even 450% of GDP, depending on how you count GDP. That's way, way beyond the traditional crisis point, which people usually put around 120, 150% debt to GDP.
Well, yeah, they're so far past that line, the line is a dot to them.
So does this mean the sensational headlines are right? Is China actually on the verge of some kind of catastrophic economic collapse?
It's really natural to jump to that conclusion based on those debt numbers alone. They look terrifying by conventional metrics. However, and this is a crucial however, there's a major mitigating factor that's often overlooked when comparing China to, say, the U.S.-China's vast government assets.
Assets. How does that factor in?
Well, think about personal finance. You don't just look at someone's debt compared to their income, right? You also look at their debt compared to their assets, their house, savings, investments. It gives you a fuller picture of their financial health.
Okay, makes sense.
Now, consider the U.S. federal government. Its net worth is actually deeply negative, something like negative $40 trillion. It owns assets, sure, military equipment, federal land, buildings valued at maybe $5.6 trillion, but those assets are small relative to its total debt, and most are highly illiquid. You can't just sell off Yellowstone or an aircraft carrier to pay down bonds.
Right, not easily.
China's situation is fundamentally different. For starters, the government officially owns all land in the country. It rents it out on long-term leases, often for decades. And this land, especially around major commercial centers, is worth an absolute fortune.
So the land itself is a massive asset on the government's books.
The huge one. And critically, remember all those state-owned enterprises we talked about? The ones holding $30 trillion in debt.
Yeah.
From the government's perspective, those enterprises are also assets. Many of them even have shares listed on stock exchanges, which means theoretically the government could sell off stakes in them if it needed cash.
Ah, I see. So the debt is linked to an underlying asset the government controls.
In many cases, yes. Plus, the government owns most utilities, power grids, water systems. Unlike in many Western countries where these might be private or ongoing expenses, in China, they are government assets. So while estimates vary, some studies, like one from the Chinese Academy of Social Sciences, suggest China's government actually has a positive net worth, maybe around $40 trillion. Other estimates are lower, maybe $20 trillion, but still significantly positive.
Positive 40 trillion versus negative 40 trillion for the U.S. government. That's a pretty stark contrast.
It is, and it implies a much healthier overall balance sheet than looking at debt alone would suggest. The significance is this. China's debt, while enormous, was largely built up creating government assets, infrastructure, SOEs, land value. It didn't just flow primarily into household wealth or consumption like often happens in the US. This theoretically makes managing the debt easier, or at least different. Reducing debt by selling assets might be more feasible for China than, say, raising taxes or cutting spending drastically in the US, which can be politically and economically destabilizing.
Okay, so the assets provide a huge cushion. But is it all smooth sailing then?
Not quite. There's still nuance here. While the central government borrows very cheaply, remember those provincial governments and the SOEs, they often pay significantly higher interest rates, sometimes up to 10%, for riskier SOE borrowing.
Right, because they don't have that direct line to the state banks quite the same way.
Exactly. And they're perceived as riskier borrowers. So the overall debt burden isn't uniformly cheap to service. It creates localized financial strains. And let's revisit inflation. We said consumer price inflation, CPI, is low, but that massive money creation had to go somewhere. It effectively bulged out into asset prices, specifically real estate. The bubble. And while building apartments creates GDP figures, it's not necessarily the most productive use of capital for broad, sustainable economic growth compared to, say, investing in new technologies or boosting consumer demand. So the risk remains. If that housing bubble seriously falters, or if general consumer inflation does eventually take hold for some reason, China could face immense trouble. A debt burden that large, even if mostly internally held and asset-backed, is inherently unwieldy. It limits flexibility.
It really brings us back to this core understanding, doesn't it?
Yeah.
China just operates under a completely different economic logic than the USA. They seem like economic mirror images in some ways.
In many ways, yes, inversions of each other.
You've got the U.S. with its, often underregulated private sector versus China's heavily state-dominated system. America's chronic overconsumption versus China's persistent underconsumption. The U.S. battling inflation while China deals with consumer deflation.
The contrasts are stark.
And when it comes to this whole debt picture, it seems far less adversarial, less like a lender-borrower confrontation than the surface narrative suggests. Yes, China buys U.S. debt, but it's also effectively buying massive amounts of its own debt from itself, funded by internal money creation and channeled through state entities.
That's a good way to put it.
So a real economic falling out between these two giants. It wouldn't really produce a winner, would it? It seems like it would just create global losers.
Absolutely. Their economies are too intertwined, despite the differences.
It's easy sometimes, looking at global events, to think China is just inevitably rising and the U.S. declining. But this picture suggests China has just as many, if not arguably more, fundamental economic challenges than the USA.
They certainly have their own unique and massive set of problems.
They're just maybe a lot better at keeping them under wraps, out of the public eye.
That seems fair to say. The underlying cause of this truly unique economic reality, as you said earlier, it rests fundamentally with the nature of the Chinese government itself and its central, all-encompassing role in pretty much every facet of the economy.
So thinking about how differently these two massive economies work, and yet how tightly linked their fates actually are, what does this deeper understanding of hidden debt, state assets, and these unique structures really mean for the future of global stability? And maybe more practically, how should you, listening to this, assess economic news and headlines coming out of countries that clearly operate outside that traditional free market playbook we're used to? It's definitely something to think about. And as you ponder that, make sure you're keeping up with the latest global analyses. Please do subscribe to Geopolitics Gazette to stay informed. Thank you so much for joining us for this crucial examination today. We'll catch you next time.